It's me, Stephen Thomas, with Reports on Housing with yet another housing debrief. I invite you to like this video as well as subscribe to our YouTube channel. We have over 5,000 subscribers and want to continue to grow. And that's because we want to get the word out to as many people as possible. We want to bring you real data, real stats, real facts, not a narrative that we're trying to play out, so that you can make great decisions based upon having proper expectations. If you want a copy of this presentation, you need to be a subscriber to one of our many reports. You can go to reportsonhousing.com to subscribe. This week's housing debrief is on Wall Street owns a lot of homes. And everybody immediately goes to BlackRock, but there's BlackRock, Vanguard, and State Street that are very involved. It's not them directly. They have other companies that do the purchasing of these properties across the United States. But the top 5 players in this investment arena by name, the first one is Progress Residential. They have 90,000 single family rentals, and Invitation Homes has 83,000. American Homes for Rent has 60,000, Tricon has 36,000, and Home Partners of America has 28,000. Now, if you add those 5 up in total, it's 297,000 homes, total single-family homes across the United States that they own as rentals. And there are 91 million single-family homes across the United States. They are, as far as ownership is concerned, they own 0.3% of the housing stock. Now, the total single family rentals, now there's going to be, out of that housing stock, there are a lot fewer that are actually rentals. Now, out of the investors that are rentals, that have these rentals, there are 23 million. So 297,000 of the 23 million is only 1.3%. And I want to also show you this. This is institutional buyer residential home purchase shares in the various markets in 2021, and you could see where they did a lot of purchasing was actually along that Sun Belt from Texas, Oklahoma, Louisiana, all the way along there. You could see that Sun Belt that they did an amazing number of purchases in 2021. And when they purchased so many in 2021, that is where they gained their reputation of investors purchasing a ton of homes in the marketplace. But is that really what's going on? Well, the investor market share across the United States, you could see that it started off like at 6% back in like 2000, a little bit higher, 7%, but then drilled down a little bit that year. You could see where it's gone. Each of these years, there's a great number that they purchased, then it comes down. So each one of those spike marks is a year. And you can see over time it has been growing, but in 2021, it was over 20% of the entire marketplace. All homes that were purchased by investors. Since then, since we've really slowed down, it is now only 16%. And you could see the appetite for these purchases has really diminished once interest rates started to really go a lot higher. And you could see right here that it is down considerably year over year. The second quarter of 2023 is actually down 45% compared to the second quarter of 2022. And the monthly home purchases by investor size, this is extremely important. You need to understand this. There are different kind of investors. There's the mom and pop, there's these other small investors, there's your medium investors, and then there's the large investors, and then the mega investors, like those top 5 that I was talking about. So, but let's look a little bit more closely as to the total share of purchases on a monthly basis. You could see that the mega investor and even the large investor, they're a small portion of all the investment that's going on. And you can see here, this is Wall Street, is that light blue, and that darker blue is larger investors. Now, let's take a look at the small mom and pop. The small mom and pop, these are those people that have these great interest rates and they don't want to sell their house. They want to hold on to their low interest rate and rent it out. Those are called small mom and pop. So those are the small investors. And even the medium-sized investors that have several investments, they're not as many as the small mom and pop, and that's the lighter blue. Not the light blue that was medium investor. You can see it. It's right below the small mom and pop. And as far as year-over-year growth of investor purchases, year-over-year growth, this is a surprising one. This, again, explains to you what happened in 2021. In 2021, it was off the charts. Keep in mind, 2021, we had very low interest rates and we had a very robust housing market with values going up very fast. And you can see that since then, it has really come down and has since, of course, gone negative. Now, as far as the investor market shares, what is this? What does the line look like? What is the trend? Well, you can see the trend slowly but surely since 2000 is more and more investor purchases, that this thing continues to absolutely grow. And where it was at 8%, it finally hit 8% for the first time in 2003. And then a few years later, in 2007, or actually this is 2005, it hit 10%. And it continued to grow. Then we have the Great Recession. The Great Recession, it looks like it flatlined, but I need to explain something that happened during the Great Recession. During the Great Recession, the government got together with some of these investment firms and said, we do not want to foreclose. We don't want banks and lenders to foreclose on everybody out there. We instead would like for these investment firms to come in, purchase the asset at peanuts on the dollar across the United States and continue to rent out to those people. So that was the beginning of getting these mega investors into real estate. And then they were really into real estate. When they saw what the returns looked like, the mega investor, all of a sudden their appetite grew like crazy because they saw, oh my gosh, there is a lot of potential here. Major upside in investing in single family resident rentals across the United States. They might not have wanted to continue to go down the path of taking care of people that were foreclosed on because there were some bumps along the road. But once they kept those assets and moved in some people that were very creditworthy, as a result, they had great tenants and they were making very, very good income. So you could see that where this increased appetite led. This increased appetite led to 2013. They became almost 16% market share of everything that was sold were to investors. And then it broke through that 16% for the first time, and that occurred in 2018. And then you could see further on over here in 2021, it was over 20%. So you could see this increased appetite of investors. So where does it go from here? Where does it go? It could, as soon as this market turns, when this market turns and we see mass appreciation, we see interest rates coming down again, which is what is going to happen down the road is we're finally going to get interest rates to come down. And when we have those interest rates come down, we're going to get immense demand and we're not going to get enough homes on the market. And what that's going to create is a lot of activity. And who's going to win is going to be a lot of cash buyers that are out there, including investors. So they'll be there, and we'll see values skyrocket up again. So you're going to see these mega investors or investors just get involved in residential resale. Again, their appetite will again increase. But there is a moral hazard to this because right now at 20%, there are 1 out of every 5 purchases goes to an investor. Now, what we have to look at is this ruining this dream of home ownership to many? There's this argument that people are just fine with renting, but I'm not for sure certain that that argument really holds out. If we were to do proper surveys, we'd probably find out that argument was actually something made up by these investment houses that are looking to, they can find people that will say what they want to say, but by and large, everybody would like to purchase a home, the vast majority of United States citizens. It's not all about money. So this is the moral hazard that we have to look at, and we're going to have to look at legislating things so that they don't continue to grow and continue to be 25% or 30% of all purchases end up being investors, because that will definitely separate the haves from the have-nots, and it will deplete that middle class. So I'm not going to get into politics, but really at the end of the day, this is what we have to take a look at is, man, we can't have them owning everything and then everybody becoming permanent renters. Because at the end of the day, the real issue is we don't have enough inventory, and we're not going to get a lot of inventory because of the way Dodd-Frank in 2010 made it so that lending was a lot better, and now we have tight lending, and as a result, we have an extremely strong housing stock. So we're not going to all of a sudden get a number of people to come on the market all at once to replenish our housing inventory. So we don't want this minimal inventory to be all sapped up by investors. If you would like to be a subscriber to one of our many housing reports, go to reportsonhousing.com. The most recent one that came out, all the counties have it now. It's called Challenges of Supply Situation. I go over the challenges of supply situation. How did we get here and where are we going from here? And if you would like to subscribe going to reportsonhousing.com, please use the coupon code INVESTORS for a free month. Make sure that you listen to our podcast. Our most recent one was titled Wild Economic Week, but we are doing another one tomorrow that will drop next Wednesday, so stay tuned for that. I want to thank you again for staying tuned for another housing debrief. I hope you have a fantastic finish to your week, and we will see you on the other side.